Hi, my name is Saddam Said. Welcome to CBSE Board Economics. Today we'll be discussing other five new topics or questions for your board examinations. This is a part of National Income Accounting in macroeconomics. So what you have today, prove that net value added at factor cost is equal to income generated or factor incomes or factor payments. Net value added at factor cost is equal to income generated or factor incomes or factor payments. So you have the formula sales plus change in stock. Change in stock is equal to closing stock minus opening stock will give you gross value of output at market price. From gross value of output at market price, if you subtract intermediate consumption expenditure, so this is not depreciation, intermediate consumption expenditure, you get gross value added at market price. From gross value added at market price, if you subtract depreciation, or we call it as consumption of fixed capital, you get net value at market price. From net value at market price, if you subtract net indirect taxes, that is indirect taxes minus subsidies, you get net value at factor cost. So ultimately, this net value at factor cost is the income generated by the firm. It is distributed among the four factors of production as rent, wages and salaries, interest and profits. Now let's start in detail. The first one you have, we already discussed earlier, gross value of output, gross value added, net value added at market price, net value at factor cost. So let's recollect what you learned earlier. So the first one comes gross value of output at market price. What exactly is GVOTMP, gross value of output at market price? Let's recollect. We discussed to produce any commodity, the firm requires or needs four factors of production: land, labor, capital, and entrepreneurship. We discussed already, without this, you just can't do any production. Plus, the firm requires some intermediate goods or secondary inputs, we call them raw materials. With the help of these four factors of production and a lot of other secondary inputs or intermediate goods, the firm produces the output. If you evaluate its value in the market, we get gross value of output at market price, GVO at MP. How do you evaluate in the market? We discussed already. The number of units produced by the firm multiplied with the market price, or sales plus change in stock. Change in stock is equal to closing stock minus opening stock, or domestic sales, exports plus value of goods kept for self-consumption plus change in stock. That is closing stock minus opening stock. So we discussed already, that is GVO at MP, gross value of output at MP, market price, sales plus change in stock. To find out the value addition made by the firm or the producer, we subtract intermediate consumption expenditure, because the firm purchased these raw materials from other input, from other firms, because the firm has not produced. So the firm has not done, the firm has only done value addition to them. The firm has not produced. Let's subtract the value of these items from the market. So that is gross value of output minus intermediate consumption expenditure. We get gross value added at market price. So already we've taken an example. The firm must have produced sugar and sold it for 100 rupees, but the firm has not done a value addition of 100 rupees to produce the sugar. The firm has purchased sugarcane from the farmers. let's subtract the value of sugarcane, that is maybe as rupees 60. So the firm's value addition is only 40 rupees. So GVO Tempe minus intermediate consumption expenditure, we get gross value at market price. Now we go to the third concept, which we have learned earlier. To produce these commodities, there is some wear and tear of the firm's fixed assets, buildings, machines, that we call it as depreciation or consumption of fixed capital. So from the gross value at market price, let's subtract depreciation. We get net value added at market price. So GVO Tempe minus intermediate consumption expenditure, GVA Tempe minus depreciation or consumption of fixed capital, we get net value added at market price. So we learned it here. Sales plus change in stock, closing stock minus opening stock will give you gross value of output at market price minus intermediate consumption expenditure, you get gross value at market price minus depreciation, you get net value at market price. From this net value at market price, let's subtract let's subtract net indirect taxes. Net indirect taxes is the difference between indirect taxes and subsidies. NIT is equal to IT minus subsidies. By subtracting NIT, you get net value added at factor cost, NV at FC. Now we come to the lost concepts in the value added chapter. Now the firm is left out, net value at factor cost, after subtracting everything. So this net value added at factor cost is the contribution of 4 factors of production, because they are instrumental in producing the output. Without these 4 factors of production, the firm could not have produced this output. That is land, labor, capital, and entrepreneurship. So they have a share in it. They have a share in the net value added factor cost of the firm. So the firm distributes this net value added factor cost among the 4 factors of production. That is, the firm pays rent to land, the firm pays wages and salaries to labor, the firm pays interest to the capital, and the firm pays profits to the entrepreneur. So this is distributed among the 4 factors of production as factor payments or factor incomes. When the firm pays to them, we call them as factor payments. When these 4 factors of production receive, we call them as factor incomes. So ultimately we prove net value factor cost is the income generated by the firm. This is distributed among the 4 factors of production as rent, wages and salaries, interest and profits. So ultimately we proved that net value at factor cost is equal to income generated or factor incomes or factor payments. Repeat once again. It's a very important concept. Gross value of output, gross value added at market price, net value added at market price, net value added at factor cost, which is nothing but net value at factor cost is equal to income generated by the firm, which is distributed among the 4 factors of production, that's factor income, that is equal to factor incomes or factor payments. Let's do one more final revision. To produce the first one, to produce a commodity, the firm uses the 4 factors of production, that's land, labor, capital, and entrepreneurship. These we call them as 4 factors of production. Apart from these, the firm uses the secondary inputs of raw materials. With the help of these 4 factors of production or secondary inputs, the firm produces the output, that we call it as gross value of output. Now, this is the first concept, GVO Tempe. From GVO Tempe, by subtracting intermediate consumption expenditure of the firm, that is the money the firm spent in buying raw materials and all, we get gross value added at market price. This is exactly the value addition made by the firm. From this gross value at market price, let's subtract depreciation or consumption of fixed capital, because there is some wear and tear of the fixed assets. We get net value at market price. From net value market price, let's subtract net indirect taxes minus subsidies, you get net value at factor cost This is the actual income generated by the firm, which is distributed among the four factors of production as rent to land, wages and salaries to labor, interest to the capital, and profit to the entrepreneur. So hence it's proved that net valued factor cost is equal to income generated of factor incomes of factor payments. So this is what we have. In fact, I tell you one concept here. The net value at factor cost is the contribution of this firm to NDP, net domestic product. So when you take the net value added factor cost of all the firms within the domestic territory, you get NDP at factor cost. So that we'll be discussing later. NDP at factor cost. NDP at factor cost is nothing but the net value at factor cost of all the firms taken together. I'm sure you must have followed it here. Look once again, prove that net value at factor cost is equal to income generated at factor incomes and factor payments. Sales plus change in stock, closing stock minus opening stock will give you G8MP. From this intermediate convention expenditure, we get G8MP, depreciation minus depreciation, NV8MP minus NIT, NV8FC, which is distributed as rent, wages and salaries, interest and profits, income generated in factor incomes. That's all we have time for today. Thank you very much for watching it. And now, till we meet next time, it's goodbye. Saddam Hussein here. Bye.